Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Paul Davidson of Octopus Ventures to talk about the Octopus Apollo VCT. Hello Paul, welcome back to the studio. So we're here to talk about the Octopus Apollo VCT. Firstly, what is it, what makes it different, and why should investors consider it?
Hello, Jonathan. Thank you for having me here today. So Octopus Apollo VCT is the second largest VCT in the market. It has approximately 400 million in assets under management and around about 40 portfolio companies, which makes it a very balanced portfolio. The way that the fund invests is to typically target companies that are operating in the B2B or business-to-business technology or specifically software space. And we're really looking for companies that are generally making around about £1 million of annual revenue, that are seeking to raise £2 to £10 million in growth capital. What I think makes the fund a little bit different to other VCTs or VCs in the market is that Apollo is generally looking for a more consistent level of returns across a majority of the portfolio. Whereas in the conventional VC space, typically you're looking for a small number of outlier returns to generate the majority of the fund's performance.
So Paul, for those who aren't familiar, could you give us some background to Octopus Ventures and your own experience?
Yes, with pleasure. So Octopus Ventures is part of Octopus Group. Octopus is the largest investment manager of VCTs across the UK. It is a B Corp, which means we take a lot of pride and passion in the impact that our investments make, as well as the financial return driven by those investments. The mission of Octopus Ventures itself is to invest in the people, the ideas and industries that will change the world for the better. We do that through investing in companies, entrepreneurs and founders, right from the earliest stage of them creating a business, so that is the pre-seed stage, all the way through early to late stage venture and growth investing. So we're really trying to support companies from early stage all the way through that growth journey. In terms of my role, so I'm a partner within Octopus Ventures. I'm the lead fund manager of Octopus Apollo VCT. My role involves trying to find great, exciting companies to invest in, then actually making the investments themselves, working with those businesses to help support their growth ambitions, and I'm also responsible for the overall performance of the fund itself.
And so turning to the investments you make in the VCT, what sort of companies are you looking for? And are you more of a sector specialist or a generalist investor?
In this market, in the kind of VC ecosystem, the best companies, the best founders, they often want to be backed by investors that really understand their business models. That means we try and take a specialist approach. So our specialism is investing in B2B software companies. What that means is we like investing in companies that have heavily contracted recurring revenue streams. They've got good gross margins, which means they are very scalable. And they're ultimately companies that can get to profit using our capital to grow them on a kind of standalone basis. So the kinds of companies we're looking for are generally more commercialized in nature. They're slightly more established and mature. They're still very early stage and they're still kind of growing very fast, but they're a little bit more mature and a little bit more established than investing in pure startups. So those are the types of companies that we really focus on.
And do you have some examples of recent investments you've made?
Yeah, we've made a couple of really exciting new investments. One is a business called Definely. Definely operates in the legal services space, which is, I think, a space which is really undergoing massive digitalization. So the founders of Definely, they are two former corporate lawyers. They've seen the pains and the challenges with producing legal documentation, drafting it, getting it amended and getting it completed. So what they have developed is a platform which uses a lot of generative AI to actually develop these draft documents from scratch, helps to then produce them and sends them to the other side, as well as then annotating them and reviewing them, making the whole end-to-end legal documentation process much more efficient and much more streamlined. Another company that we invested in is a business called Semble. And Semble sells its software in the healthcare space, primarily the private hospital space. And I like to think of this company as almost like the operating system for a private hospital. So with Semble, what you can do is actually manage all of your patient records, manage booking, scheduling, medication management. It really helps to, I guess, digitize the experience between the hospital and the consumer or the patient themselves. So this is a business that we've seen great growth in. It's mainly operating in the UK today, but our capital is going to help that company expand internationally.
And so I guess it's one thing finding these deals, but how do you, well, firstly, how do you find them? But then crucially, how do you win these deals? And are there any advantages to being Octopus?
Yeah, we use a range of different methods or origination sources. We have got a very broad and very wide network. Our brand, I think, really helps us in that regard. We have a lot of introducers. These can be corporate finance advisors or brokers. We also use our executive network, so people we may have worked with in the past. These could be non-execs or former execs that we have also backed. And I think one of the other areas that we have spent a lot of time trying to finesse and develop in the last 3-4 years is to try and create a direct sourcing or direct origination model. What that means is we try and map entire markets or subsegments. We will then reach out to all of the companies that are actually in that particular segment themselves, benchmark them, get a good feel for which ones are doing well, which ones are maybe not quite at the level that we want to see as an Apollo investment. And we then track those companies over time. And hopefully then at the point when they're actually raising, we're in a great position to actually finance them and be in pole position because we have built that relationship with the company. I'd say the other advantage we have just goes back to our investment focus, where I said being a real specialist in software does help us to, I think, win those opportunities to invest in companies when you're competing with, say, other more generalist VCs or VCTs.
And so turning back to the portfolio, do you have any examples of perhaps some more established holdings in the portfolio that you can talk about?
We have a number of companies which have been quite resilient and quite robust over this recent period. One of our holdings is a business called Natterbox. And Natterbox is a business that operates in the cloud telephony space. Think of it as a platform which really helps to synchronize the experience between when a consumer calls a company and it goes through to a kind of contact call center and all of the information that a company holds on that consumer itself. So it's really helping to try and enrich that experience with the consumer. It's a business that we invested in, I think, almost 6 years ago now, when it was only a few million of revenue. Now it's doing extremely well. It's probably 5+ times larger than when we first invested. Is one of the largest holdings in our portfolio, and we're still seeing really great growth from that asset. So a really kind of good story for the VCT.
So Paul, to what extent do you get involved in these companies? I think there's probably two schools of thought. You find great management teams and leave them to it, or you get involved. To what extent are you getting involved with companies?
Yeah, I mean, Jonathan, we are, so we always invest on a minority equity basis. So we're never a majority investor, and we're never kind of telling management teams what to do. So we're always trying to back great management teams. But we do try and add as much help and support as we possibly can. I would say they come in kind of three main areas. The first one is obviously the capital that we have at our disposal. So we have got quite a large fund, thankfully, which means we can follow on into our investment companies, really continue to back them and support them as they continue to grow and move through the different stages of their journey. The second area is around talent. So we have an in-house talent function, which is really trying to help anything from organizational design to trying to find the right executive talent. We support with remuneration benchmarking. And I guess our companies often use it a bit like an outsourced HR function. So we see that as being hugely valuable. And the third area is distribution. So how do these companies grow their top line? How do they grow their revenue? And we really try and bring good professionalization to that through the experience we have in our team. But also we use a range of operating partners and go-to-market partners which work directly with our companies to really support them with their top-line growth ambitions. So it's quite a holistic model. We do like to get involved, but always in a try and guiding and influencing and supporting sense.
And I guess the ultimate goal is exits, and it's been I'd say a fairly quiet time for exits in the market. Have you seen any exits recently?
Yeah, I would agree with that. I think it's been a really tricky time through 2023 and early 2024. A lot of the companies in Apollo will probably exit to large corporates or PE-backed corporates. They're probably less likely to go down the IPO route. And a lot of those buyers in the last 24 months have probably sat on their hands a little bit and have focused more on their own companies. So It's been definitely a slower period of time. We have actually seen an exit of one of our older holdings, which was a company called Countrywide Healthcare Supplies, a provider of healthcare supplies into the kind of care home space. And that business was sold to PHS Group. It was actually a record multiple for the fund. So I guess that is giving me some confidence that the exit and M&A market is starting to open up. And I think we're going to see more opportunities in that for exits in the next 6 to 12 months.
Very good. And it's, of course, it's for every good exit, there are failures. Early stage investing is fairly risky. How risky is the Apollo VCT? And is there anything you can do to help manage the risks?
I think it's very difficult to get away from the risks that are inherent in investing in early stage companies. Apollo is definitely not immune to that, but I guess there are a few things that we do which help us manage that risk. I think the first thing that we do is just the types of companies we're investing into. So they are more commercialized and they are more established than a pure startup. That just means that the kind of failure rate for those types of businesses is just statistically lower. The other thing is because we're focused on software companies, these are generally businesses that have a need and a demand through recession, through the cycle. We're not trying to find companies that may just be flavor of the month and do well in say, an upmarket or a positive economic climate. So we've seen good robustness and resilience even through this period in the last couple of years. And the other thing is when we're investing in our companies, we're generally trying to find capital efficient businesses. That means we aren't necessarily investing and backing them to the next financing round. We may be backing them to profitability or to break-even status. So there is a lot less inherent volatility in the performance of those types of companies because they're not necessarily just being funded to that next financing round, which may or may not be there in 12 or 24 months' time, which I think a lot of VCs and VCTs have suffered from in the last 24 months.
And so turning to the current environment, it's been, I guess, 22, 23, 24 has been a reasonably tough time for venture. How are you finding the environment today?
It's opening up. We are seeing, I think, a renewed level of optimism from the companies that we're meeting. I think the stabilization in the macroeconomic climate, interest rates, inflation is creating a more conducive environment for companies to grow and to raise money. I would say in 2023 and early 24, it was really quiet, but in the last 6 months, we have seen more investment activity and more opportunities than the fund has seen since I would say 2022, frankly. So we've closed a number of new investments. We have a really strong pipeline of new investment opportunities as we sit here today. So I'm actually quite positive about how the next kind of 6, 12, 18 months looks from the investment side.
Very good. So to sum up, Paul, for those that want to invest in a VCT this year, why should they consider the Apollo VCT?
Well, I think for anyone that wants to gain access or an exposure to early stage, high growth companies, then Apollo is a really strong complementary product to that. Because if you've already invested in EIS or VCT funds that have more of an early stage or startup focus to them, Apollo is probably complementing that strategy by providing you access to a portfolio of slightly more mature, more established companies. The other thing I would say is because we're investing in B2B software companies, and the valuations for those companies have come down, I actually think it's quite an exciting time to be investing because I think we're entering at much more attractive valuations than we were a few years ago. And that gives the fund great opportunity to deliver great fund performance and fund returns in the years ahead.
Paul Davidson of Octopus Ventures, thank you very much.
Thanks, Jonathan.
If you're watching on YouTube, please press like and subscribe to the channel for more.